Investing in exchange-traded funds or ETFs has gained significant popularity in recent years, providing investors with an easy way to diversify their portfolios. High-yield ETFs in particular have attracted attention due to their potential for generating substantial income. And in some cases, these high starting yields can be great and can offer investors instant high rates of returns and cash flow because of the higher than normal dividends. However, it's important to consider the drawbacks and risks associated with these investments. And in this video, we're going to go over 3 specific reasons why investors should be wary and or never even bother investing into high yielding ETFs at all. Now we're going to go through all this and more today. Right after you, please drop a like in this video and subscribe for more content like this in the future. Now the first reason why it might not be a good idea to ever invest in a high yielding ETF is going to be because of the price decay. Now what I mean by price decay is the fact that a lot of the higher yielding ETFs, especially some of the covered call funds, might offer, for example, a trailing 12-month dividend yield like 11.47%. like that of Q yield. But if you were to look at this covered call ETF on the max time frame on the chart, over the past 10 years or so, Q yield was trading at around $25 per share, and right now is trading at around $17.72 after a recovery where Q yield was recently trading around $15 per share. Similar to that of Q yield, like R yield, if you look at the max time frame, it's also down 29.61% as far as ETF price, which means that investors that bought into a fund like this around inception date are currently down on their holdings around 29 or 30%. Now, of course, the argument is that some of these funds offer such a high dividend that it will definitely make up for some of the price decay over the long term. But all I'm saying is that there are other higher quality dividend ETFs out there, something like SCHD, for an example, that doesn't decay in ETF price and actually appreciates and will actually most likely continue to appreciate over time, as well as pay out a pretty decent sized dividend of around 3 or 4% if the dividend is something that you're looking for, without of course trading sideways and or decaying over the time frame of you holding onto the ETF. Now, the next thing that you should be really careful about when it comes to investing into high yielding ETFs is going to be the dividend amount that's distributed on a monthly or quarterly basis and the overall uncertainty of it. Now, what I mean by this is if we look at an ETF like Decay, for example, if you look at the dividends that are paid on a monthly basis, they're pretty sporadic, and investors, especially income investors that might rely on these dividends to pay for their bills or to cover things throughout their life, these dividends are generally very much so all over the place. And although there's been multiple months historically speaking where an ETF like Decay has paid a pretty consistent amount month after month, there's also been months where this ETF paid 54 cents per share, and then the next month just 26 cents per share. So at least for me personally, holding on to funds like this sort of annoys me because you never really know what you're going to get on a consistent basis. One month the dividend could be huge, the next month it could be tiny. I get it, long term, a lot of these funds will average out to have a pretty good overall yield. But I'm just saying this is one of the things that investors should look out for and maybe be wary of when it comes to investing into higher yielding dividend ETFs. Another example of this is definitely within QYLD. There was a time not that long ago where QYLD was paying around 25 cents per share per month as far as a dividend or something around that. But as of recently, at least over the past year or so, this covered call ETF hasn't really paid much more than 16 or 17 cents per share per month. Which again, don't get me wrong, to play devil's advocate, it still is going to yield a decent amount, even if this ETF was to continue to pay around 16, 17, or 18 cents. But I'm just saying that for some investors that buy into some of these ETFs, especially a while ago, sometimes they do not only see decay in their overall principal investment, but also dividend growth is inexistent. If anything, the dividends are shrinking. Which brings me into my final reason on why investors should be very careful and maybe never invest into higher yielding ETFs. And this is because these ETFs lack dividend growth completely. For example, if we were to look at the JP Morgan Premium Income ETF, again, as an example, you can see there's been absolutely no dividend growth. And this is because the fund strategy doesn't necessarily account for that. A covered call fund like this is going to pay out a different amount every single month, most likely, depending on how the fund performs and how the underlying strategy works within that time frame. Now, this is very different when it comes to something like SCHD or the Schwab US Dividend Equity ETF, where dividend growth is very apparent, and where investors, for example, could lock in a 3 or 4% yield starting right now, and also expect, at least if history was to repeat itself, some massive dividend growth in the future. Now, for those that don't know, what this means is that for whatever shares you own as of right now, in the future, this ETF will continue to pay you more and more and more, at least once again, if history were to repeat itself. So those are 3 reasons on why I think that some of the higher yielding ETFs can get investors into trouble. And this of course goes without saying that there are certain higher yielding ETFs out there that I personally think are definitely winners. And even the ETFs we went over in this video, things like Q Yield or JETB, those are both holdings within my portfolio. And again, for those of you that might have gotten into some of these ETFs at a lower cost basis versus a higher, that's definitely favorable. But it definitely doesn't change the fact that some of these higher yielding ETFs do share some of the riskier qualities. But I want to hear from you guys down below. When it comes to higher yielding ETFs, what are some of the biggest red flags and what are some of the risks that a lot of them share? Comment down below. If you enjoyed this video, make sure to please drop a like in the video and subscribe for more content like this in the future. Thanks for stopping by, guys, and I'll see you in the next one.